Hello everyone, today is August 30th and this is excitingly the first session of the Wyckoff Trading course part 1, which is all about the analysis. And I'm always excited to start the new cycle. This is cycle number 30 plus. So I've been teaching this material for a while, to be exact, over 10 years now. And today we're going to have the session where we have both students and we have the guests for the open door session. And I'll address both of the groups. Obviously, for those of you who already signed up for the course, I'm looking forward to working with you this semester. It's going to be a lot of work. You probably already know this. Because you've checked out our material either on YouTube, on Twitter, or you communicated with us, you know exactly what I'm going to do. I'm going to give you a lot of material, a lot of knowledge, and we're going to do a lot of exercises. We're going to do a lot of drills. So each class will conclude with some kind of home assignment. Be prepared for that. Right away, also for those of you who are already students in this class, I want to make sure that your homework submission is going to have a specific file name. I want your first name, the letter of your last name, the class, because we have different classes, and then the number for the homework. This is very important because we receive quite a lot of emails, and it takes time for us to sort those through. Secondly, our next session is going to be on September 6th. So on Mondays, we're going to meet at 3 to 5:30 Pacific. And our classes, and especially going into October, are interactive. So therefore, for those of you who would like to participate in the discussions, in the classroom discussions, you have to make sure that you have a headset with the built-in microphone so that you will be able to talk to me. Now, all of the recordings and slides for students will be uploaded tonight to the class page, which is behind the password wall. And Nancy will send out tonight, probably around 8 p.m. Pacific, an email with the access information. So you will have that. Okay, so that's for the students. For those of you who are guests and you guys are considering joining us at some point, you are welcome to join us. Go to our website, wyckoffanalytics.com, find WTC Part 1 course. If you have any questions, ask Nancy at wyckoff@gmail.com. We still have the payment plan that's going to be working until the end of tomorrow, and then it's going to become 3 recurring payments. So you still can do that. And then for those of you who are alumni of the WTC, as usual, you could join us at the discounted rate. We have probably several alumni in this cycle. I'll have to double check on that. Welcome back, and I'm looking forward to working with you. So what are we going to everything that we talk about in our classes is for educational purposes only, so stop the recording, read the disclaimer in full. Okay, let's talk about this really quick. We've got our weekly newsletter, which is completely free. So what happens there? Usually we give you some kind of market update. We give you our latest videos that are coming out this week. We give you our latest blogs that are coming out this week. Also check out our Wyckoff Trading Method YouTube channel. We've got quite a few videos there that are legacy videos. We have the new sub-channel there, which is the market update channel. So you literally can go each day there and find some kind of series on some kind of subject of trading related to Wyckoff. Also, if you are active on Twitter, I would definitely suggest signing up to our handle at Wyckoff Analysis. Regularly, we post not just the announcements about the classes or what's going on at Wyckoff Analytics, but during the school year, I post almost daily something Either it's on stocks or on cryptos, Bitcoin specifically, or any other instruments. And actually, our engagement on Twitter probably will increase this semester, so I would definitely recommend that. Okay, so let's talk about WTC1 curriculum. What are we going to do? Well, first of all, I kind of identify in 2 words this course, the part 1 specifically. It's all about the analysis, but it's also all about the knowledge. So I'm going to give you beginners and intermediate type of knowledge with a lot of details on the advanced level as well. I have kind of like this practice where I can talk about the very simple ideas and then go really quickly into the advanced level and just show you the complexity of it as well. So for the first 5 sessions, our concentration is going to be on the market structural analysis. Specifically, what's important to us, Wyckoffans, and just traders in general, to identify on the chart. A change of character. We want to understand where the trend ends, how it ends, specifically the characteristics, what happens next, how could we identify the change again going into the other part of the cycle. So that's going to be the primary concentration when we're going to be talking about the change of character and the change of behavior. Those are 2 different things. We'll talk about different price structural environments and specifically what is required for us to identify there. Well, right away, I'm going to tell you that in the consolidations, we're going to be looking for the bias. We're going to be looking for the timing of the price getting out of the trading range. And also, we'll be looking at the character of the potential move out of the trading range. We'll talk about how trading ranges are unfolding. There is a specific sequence. It's not linear though, because some of you will be thinking that, oh, okay, it's going to be 1, 2, 3, 4, 5. Well, in some sense, yes. When we talk about the phases, we know that the consolidation is going to start with the stopping action, then with the exhaustion, the final test, and then a change of behavior. So those are going to be very linearly defined by us, but there are quite a lot of nuances and variations on the way how the trading ranges are going to unfold, depending on the availability of the supply and demand at the same time. And to help us out with this, we're going to identify specific Wyckoff events, such as selling climax, sprints, upthrust, signs of strength, and so on and so forth. For some of you, this sounds somewhat familiar, so that's great. For some of you, this is going to be a new terminology, so you will have to learn it. You will have to remember it. And I will force you to remember it by heart. There will be specific exercises on that. Then we're going to graduate in our analysis to supply and demand, and I would rather even say volume and price analysis. Behind it, there is a very important concept of effort versus result. If there is one thing that I would love you to take from this course, from part 1, it's that. How does the effort is corresponding to the actual result? So by effort, we're always going to talk about the presence of institutional strength or weakness, and by the result we will be looking at the price movement and what that effort creates. So very, very important concept in Wyckoff terms and in general in trading or the analysis. We're going to study a bar by bar analysis. We're going to go into the swing by swing analysis. I will be explaining to you some elements of the volume spread analysis. We're going to spend quite a lot of time there. We're going to go through the systematic exercise on the volume and spread analysis. And it's probably one of the most favorite exercises that our students have at this level. So it usually produces a lot of aha moments, moments where people and students come back to me and they say like, wow, I see the market now in a different way. So that's going to be great, to come back to that exercise again. We'll talk about the volume patterns in different Wyckoff phases. So as we go through the trading range, the most important thing for us is to identify the emergence and the conclusions of the specific phases and during the consolidation that are related to, again, effort and price. And then I'll also teach you how to look at the historical analogs and how to use them in your analysis. Session 11 to 12 is all about relative and comparative analysis. This is something that a lot of people already know. And my goal always with these two sessions is to show you how we actually look at this, how we identify the stocks or specific instruments that are starting to outperform or underperform. Also, there was a specific way of how Wyckoff himself used the comparative analysis. We'll start with that. So we'll go to the basics first, and then I will give you a more modern interpretation of the comparative analysis, which is the relative analysis. I'll show you some of the proprietary things, which is, finding the sweet spots for performance, which will be having a lot of predictive value, especially for swing traders. And we'll talk about filtering and scanning to a certain degree. So I'm kind of like going to show you some of the things there. Then after that, session number 13, 14 is all going to be about execution. This is not a full body of knowledge on execution. This is just the introduction into the trade management. So we'll talk about how do we enter the position, how do we exit the position, where do we place our initial stop loss, and how do we actually move it? How do we scale in and scale out of the position? So not only we going to theoretically talk about this, but I'm going to show you a lot of the case studies and examples of that, including my own trades. Session number 15, as usual, Q&A session. So usually questions accumulate. We'll talk about how you guys will be submitting your questions. For now, I'm going to leave this discussion to the second class, but it is a common practice to ask me something about the material that we are going through. And I will give you some guidelines next week as to how exactly we're going to do that. So don't worry about that. And again, if you're feeling like, yeah, this is something that I need or I want to study with Wyckoff Analytics, with Ramon, with the group of fellow peers, just consider signing up. Okay, I'm going to skip this slide. I realized that I actually have not updated it. Well, actually, no. What am I saying? Yeah, it's actually updated. So what are we going to do? We just finished the introduction. Your first homework, and this is a very important homework, is going to be an article by Jim Forte, which is called Anatomy of a Trading Range. We'll talk about this in a second. We'll go through the market update. And then throughout the whole session, this session, I will be showing you my analysis on Bitcoin for the last month or so. I want to give you an example of how I analyze the chart and how I traded. I will show you where I took the positions in Bitcoin lately. Then we'll talk about Richard Wyckoff himself, the idea and the heuristic interpretation of the institutional presence, which we call the composite operator or the composite man. We'll start talking about the price cycle model, which is extremely important for us in understanding where accumulations are located, reaccumulations, how do they occur in the markup phase, distributions, what are the characteristics there, what is the sentiment and rationale by institutions throughout the whole price cycle. So quite a lot of information there, but it's so foundational. We really cannot dismiss that at all. And then we'll talk about behavioral market analysis. We need to understand who actually on what side of the trade, strong hands versus weak hands. We'll talk about institutional hands versus retail hands. We'll identify major market participants and we'll talk about their characteristics. And then also I will show you some case studies, which is going to be the Apple case studies. All right, I see some familiar names here. Okay, great. Good to see you. Okay, so let's talk about the homework. Homework is by the late Jim Forte's article, Anatomy of the Trading Range. It was Extremely sad news when we've learned this year that Jim passed away after some medical complications. He was extremely young to go away from us. He was extremely knowledgeable. And I still remember the classes that I took together with Jim, Hank Prudence classes, and Hank is not with us as well. He passed away in 2017. So this was a little bit of a shock, to be frank. Um, so our thoughts, especially at the TSASF, which is the local technical analysis organization here in the Bay Area, still with Jim and his family and his wife. I consider his article, and this is how I've been giving it to my students for the last 10 years. The Anatomy of a Trading Range by Jim Forte is the foundational article on the knowledge of the trading range development. Whether we are talking about just the price action itself or the effort behind that price action. So this is your homework, and if you are not going to sign up for this class, at least go to our website, download this article. We have it there, and read it. It was an MTA paper at that time, which was published in the MTO journal. And since that article, I have not, and I've read quite a few of them. I have not seen anything close to that in terms of the clarity of the message, how the trading ranges are actually unfolding. So please do read this. And this is a mandatory assignment for those of you who are students in this class. So you guys will have to read it, because the next class is going to be based on this article. That's number one. And then the homework that I'm going to give you in the next class is also going to be based on this article and the information that I'm going to give you in the next class. By the way, usually people ask me this question, is this session being recorded? Yes, it is being recorded, and we will be posting the first session, open door session, on our Wyckoff Trading Method YouTube channel tonight, so you can catch it there for sure. All right, well, let's talk about the market update. And as usual, each cycle I start kind of like from way far um, from like a daily chart. I want to show you the big mega trends, or a big mega trend. Specifically, we're looking at the Dow Jones Industrial Average here, and you could see that the channel is well defined. This is a logarithmic scale, and since the low in 1932, we are making higher highs and higher lows. We are well contained within this channel. There are some periods where the price gets out, but then it comes back to the channel. So that's number one. The secular uptrend is still up. Then let's note what happens during this uptrend. We have two major periods where the price either consolidates or it is going up in the uptrend. And usually consolidations are taking years. Look at this mega structures, 12-year in duration, mega structure in the 60s, 70s, 16 years, mega structure in the late 90s or early 2000s, 12 years. And as we know, and Wyckoff has given us this knowledge that for every rally or for every downtrend, we have to have some kind of cause. So what happens during this cause creation? Well, one or two things happen. Either there is an institutional accumulation or institutional distribution. And that's what we are looking for. When we look at the consolidations, our primary goal is to define what kind of buyers institutional investors have. So therefore, we will be concentrating our attention as to how to define the bias as the price goes through the consolidation, how to define the bias based on the phase analysis, how to define the bias based on the swing analysis, how to define bias based on the effort versus result type of the analysis. And specifically here, when we look at the rallies that are being originated in those mega structures, we see that those rallies also take place, um, you know, and duration of those rallies extend. And those rallies are usually going to correspond to some kind of big um, event in the I forgot the name, in some kind of generational type of event. So, for instance, when a large number of people, one generation, let's say like a silent generation or baby boomers or millennials, are coming into their earning power, and for let's say uh, 20 or some years, they are making a lot of money. This is producing a lot of consumption, and as we know, 70% or about 70% of U.S. economy is running on the consumption by the retail people, by the consumers. And as they're making money, they're buying cars, they're buying new houses, they are investing money, they are spending it on education and so on and so forth. So the companies are benefiting from this consumption and spending by a whole generation, and that's what produces this type of rallies. So far, we have had our latest megastructure for 12 years, and we kind of in the middle of this big generational rally, which is being fueled by millennials right now. So we still have quite a lot of time to go. Well, what about the price? Well, the price is definitely close to the long-term overbought condition. Please note how in the 50s we had this type of action where every time we would come to this level, we would have some kind of reactions. And they seem so small on this chart, but it's only because it's a logarithmic chart, because we have, almost 100-year history here. Those were meaningful corrections right here. And we certainly will have meaningful corrections going forward. It doesn't necessarily mean that we are, with those corrections, we're going to be done. We are probably going to have some kind of pauses, some kind of corrections, and then continuation. And then in some instances, when we overextend, we might reach this higher level of the overbought condition on this secular level. But so far, and after the COVID reaction, we're still up. And by the way, a lot of students were coming back to us with the question, well, what about the reaction like COVID? Isn't this is the type of the reaction that would completely break the secular uptrend? And our answer is still no, because there are quite a lot of instances of sharp reactions throughout the whole rise. For instance, 1987 is one of them. Look at how similar they look. It's the shakeout type of reaction. There are some differences, contextual differences as to where those reactions actually start, but the way how they unfold and recover are somewhat similar. And then you have, of course, 2008, or let's say 1974, which are much more meaningful structural reactions within the context of the megastructures. And we'll study those later on in the WTC2 course. Okay, let's talk about breadth. So here we're looking at all of the stocks that are above 200 moving average. And the key is going to be a thought that after the initial takeoff, where institutions are buying basically everything that is on the table, and that is producing a very meaningful and robust move to the upside. So as on the way down, they were selling in both cases in 2008 and in 2020, and they were selling urgently. They come to the low without a lot of positions. So they have a lot of cash on their hands. And as the market starts to reverse, you kind of start seeing that the breadth is starting to improve. First, breadth improves in the quality stocks, in the large caps. That's kind of like the way to go because there is a flight to safety and flight to quality. And then as the market stabilizes and starts showing some signs of the reversal, other sectors are starting to improve, and there is more of the distribution of the capital that goes and being invested into some other stocks. And that produces this big breadth that expands. Now, the biggest mistake that I see people make on those takeoff type of momentum recovery rallies in both price and breadth is that they're saying we're in the overbought condition here on breadth and we should go down. We should have a reaction. That's not the case. In all of the times that we see that the breadth is reaching some kind of very high number, we have a period of time which is being identified as still uptrending environment on the price that allows the market to still go up. So think of it as kind of like a first initial big push that pushes the market up, and then there is some kind of developed velocity that the market has where you could just continue going up and up and up, and price still goes up when we reach those high numbers. And every time we kind of have this same thing happening over and over and over. Look in 2013-14, we are basically rallying after the initial push to the upside in breadth. Here in 2016, the same. We have reached the high and then the breadth is deteriorating. So don't pay attention to all of the calls where that are saying the breadth is bad, and yet the price is going up. So most likely this is just a misunderstanding of how this type of indicator or indicators actually work. The same in 2019. We're seeing that the breadth is not really improving, yet the price is going up. And the same in 2020 and 2021, where we've reached our highest breadth ranking here. And then after that, we're still going up. And we could do that for quite some time. I mean, look in 2012, 13, 14. This was a very prolonged period of time when the price was going up and trending up. And yet there were quite a lot of deteriorations and rotations throughout, these years. So we'll study that partially in WTC1 and more so in WTC2. Okay, well, let's start with also the market update, from a different perspective. So in each class, guys, I'm going to give you my view of the market, my view of the current market. So we're going to do this really quickly as we have a lot of material today. So the first four charts that we usually discuss are the indices. And here we could see a couple of things. Well, first of all, we need to recognize that majority of the indices, except for Russell, are in the uptrend. Secondly, we want to identify the leadership. So obviously, NASDAQ is the current leader. So we're going to pay more attention to that. The latest trading range in the leader in NASDAQ has really no distributional characteristics. It only has some profit taken type of volume signatures where really quickly that supply that is emerging is being observed. And we also have a lot of interesting continuation characteristics in where momentum is increasing. We see this in the spread of the price compared to the previous uptrend movement. And that also happens not necessarily on a very large volume signature. So that tells us that supply has been observed and supply is in strong hands. And that's what we're looking for. We're looking for those type of the situations where supply is in strong hands, and that allows the price to go up even on the behind the diminishing demand characteristics. Another thought here is about Russell. So I think that Russell is very fascinating at this point, just because it has been staying in the trading range for quite some time. And we've identified this area right here, and specifically this reaction, as the potential phase C. And so far, it's working out. So we're thinking that we're in phase D and some kind of sign of strength. Why is that? Well, let me kind of really quickly go through the analysis right here. So we have seen this rally, and we've talked about this, where looking at the upward spread, we're seeing some kind of deterioration in the momentum. So we are not seeing big expansion spreads. We're also seeing deterioration in volume signature and specifically demand signature. So behind that, even though we said that this looks bullish, and the bias for this whole range we thought was a reaccumulation, this type of price volume action suggests that the timing is still not now. Well, when is it going to be the time, for the price to leave the trading range? Well, if it wasn't, if the price wasn't ready to leave the trading range here, it needs to do more testing, which it did. So we see that some supply is coming in. Some supply is coming in again, especially on this reaction. But relative to, let's say, the reactions in phase A, we don't necessarily see the same aggressiveness with which the price goes down. We don't see this type of spread or this one or this one. The spread, the downward spread, is somewhat contained to a smaller average, which suggests that even though the price goes down, it's still quite bullish, and we should be expecting the stopping action around the support area, some kind of reversal, maybe testing, and then a move up from here. And then specifically, this reaction and this reaction, if we would be comparing two reactions, let's say reaction number one and reaction number two, what could we say about the texture and the character of these two reactions? Could reaction number two actually confirm the bullish outlook for this whole trading range? And I think it does. Why? Because again, we see how volatility is diminishing on the second reaction. We're seeing how the downward spread is diminishing as well, which is a bullish characteristic. We see a slightly higher low relative to the previous low. And also, what's important, we see quite a dynamic recovery, which is followed by a flat test. And this was very important to call, just because on the continuation, we were expecting that the price is going to start moving towards the resistance. Whereas right here, the test, somewhat deeper. Also, there are some volume characteristics that allow us to identify less demand at the point of the reversal, which suggests that supply is much more absorbed at this point. And that all points to still bullish scenario, at least for now. I would be expecting that Russell will be overcoming this resistance on this rally. Definitely still weaker than anything else, but still very much bullish. Okay, we'll talk about the Bitcoin later on. I know that a lot of you are interested in this, but in the anatomy of the trade, I will walk you through quite a lot of ideas, and I will suggest some pathways as to what Bitcoin could do next. So stay tuned on that. Let's talk about oil really quick. So we've had such a great rally, and this rally is all about strength. This rally is all about the leadership. Look at the types of the reactions that we have here. They are so small. They are so insignificant relative to compared to the strength of the upward move. Plus, behind it, there is so much demand. And this demand is not just a retail demand, it's institutional in character. And we're seeing how quite a lot of buys were done right here. We actually called the top here, this intermediate top, really well. Literally called the structure of 3 pushes up and then the change of behavior. It would take me a lot of time to explain why we made this call in this area the way that we did. I just kind of like want to show you and tell you the final result. But in the classroom environments, we're going to go through this, and when we discuss the market update in the future, I'll definitely show you what was the rationale and logic behind this type of call. Then what we're seeing here is the next rally was somewhat similar to that rally in Russell that we've discussed, where the upward spread was diminishing. We kind of see like very, very small spread, but still bullish behavior. It overcomes the resistance in a significant way, which still suggests that this is a reaccumulation. And then we have local increase of the volatility, which is very common for a phase C type of behavior. I really like that we are creating a higher low, that we're creating a local spring relative to the previous low where supply was quite significant. We're seeing diminishing supply character, and we're seeing decreasing volatility on the last rally reaction, which is suggestive again of the confirmation of the bullish bias. More importantly, the analog bars, the reversal analog bars that we see unfolding from both of the lows are suggesting that there is lesser demand that is required for the price to move and to reverse significant bars to the downside. Again, something that we will be discussing in the classes ahead. Some of it is Wyckoff, and some of it, and specifically significant bars, is the proprietary methodology that I've developed for myself and for my students and for my institutional clients. So I'll definitely teach you that as well. So for now, our expectation here is that after we hold in well with the test, we're going to try to overcome the downslope and resistance, and going to continue to the previous resistance at around 76. I believe that we will see much higher prices for oil above 100, probably in 2022, if not sooner. Okay, gold. Also, there is quite a lot of interest in gold, which is not surprising. I mean, like, this is a big asset. And to me personally, this has been the most enigmatic market in the last probably, half a year. Why? Well, we had a climactic run, which is well defined here, into the high of August of 2020. And then after that, we've seen a pronounced change of behavior that suggested the trading range. Well, not only the trading range has come, it has come as a downtrending environment where we see lower highs, lower lows. And that downtrending environment has been populated with so many aggressive selling bars. And that's what we're dealing with. We are basically trying to get away from that type of the behavior. And unfortunately, we're still not out of the woods. If this rally right here was considered by us a change of behavior type of rally, and the change of behavior is basically something that acts, looks, and behaves in a different way than the previous rallies. So here we're seeing, first of all, overextension. We see a more controlled buying by institutional traders. We see how the texture of the rally has changed with the expanding up spread and again, over expansion of the swings. And yet we have gone through a couple of very aggressive declines with a lot of volume signature coming in and then a lot of result to the downside. So what could we conclude here? I would be thinking that we are in some kind of much larger trading range, which is actually related to a very, very long-term picture for gold, where the price starts to interact with the all-time high. And this final move creates kind of like this major sign of strength over all-time high. And then we go into some kind of long-term backup action. And this backup action is a trading range that has its own change of behavior. And now we're in a much larger structure. It was very constructive how the price actually rebounded here off the support without violating it, without putting on a lower low. I also like how the volume signature is starting to decrease in this area, so also suggesting that volatility, should be going down, but most definitely it's not on the short-term basis. We still have quite a lot of volatility to deal with. Now, what would I do here? Well, I own gold ETF, which is GLD, and I've been having that in my IRA account since 2019. So I'm a very, very long-term oriented investor here in gold, and I'm just holding it. There is no reason for me yet, at least, to get out of this position. And it's all a matter of confirmation of the long-term trend. So for now, my advice here would be just to trade short-term, to trade small swings, 2 to 3 to 5 days, or to trade intraday, just because there is so much volatility. Okay, let's move on. Let's go to another subject. Yes, by the way, for those of you who are interested in this type of the analysis on the weekly basis, Bruce Fraser, who is my friend and a colleague in the great Wyckoff, we conduct on Wednesdays Wyckoff market discussion. This is an hour and a half packed of different type of materials and looks at the current market, at the top-down approach, where we go to the sectors, where we go to the groups, and where we go to the stock. And it's basically everything market related. So if you just want to come to us, to our universe, Wyckoff Analytics universe, and just have the product on the application, and to see how on a weekly basis both of us interpret the market, the current market, this would be the class. It's only $79, and we're going to have per month, and we're going to have a free webinar for you, open door class on this Wednesday, September 1st at 3 p.m. Pacific. So go register for that, check it out, sign up, and we would be happy to have you there. Okay, so I promised you that I'm going to talk about the Bitcoin, and that we're going to have some kind of walk through the analysis of the Bitcoin as the most recent trading range was unfolding. And I'm going to start this with this bar right here. This is the lowest low, but it's not necessarily an efficient low in terms of the duration of the trading range. So the price went like this, created a higher low, and then it went up. Having said this, the way how we analyze and the way how we trade it is actually pushed me to get into the position on this specific bar. So before we talk about this and why or how I got into this position, let me talk about this area right here. So for the longest time in this trading range, and I'm always going to be very truthful with you guys, because I am the student of the market and I'm learning myself how to analyze and how to trade. So I'm in the same shoes as you, and I'm just showing you what I'm doing, and I'm trying to help you out to see the same things that I see. So for the longest time here, we were calling this a reaccumulation. Why? Because there are no distributional signs whatsoever until this area right here. This was the beginning of the distribution on the way down. But prior to that, there is only deterioration. There is only deterioration that could be shown in the shortening of the thrust, and we've commented on that, in the diminishing volume character, and specifically diminishing demand character, and maybe some selling on the change of behavior, which is to be expected with the change of behavior anyway. Our final call to the downside was made right here on this bar. This bar identifies that there is some kind of change of behavior, which is still a high low, and which was very difficult, to go through. It's not your typical sign of weakness, but the inability to overcome this change of behavior bar where a lot of selling has happened on several pushes to the upside, where we see deterioration of the demand and the ability of the demand to overcome this selling bar. And then a bar where we're seeing finally the emergence of the supply and expansion of the downward result. That was the final call. And then from here, it was quite easy. Actually, I thought that this was a really great call right here on this bar. We just called and said that there's going to be a continuation, and not only that, in one day we're going to have something stupid. We're going to have probably like a 10,000 minus 10,000 thousand dollar day, and it happened this way. So this was just kind of like a miraculous call. And then we're going through the trading structure. So in the way how we would be interpreting or labeling trading structure is that we're going to have a stopping action, which is going to be our climactic action. We're going to have the first rebound up, which is going to be an automatic rally. And we'll go through this, so don't worry. For those of you who are already students, I will go through all of those Wyckoff events. I will explain those to you in a lot of details. Then a secondary test, a local secondary test, which is testing the climactic action, and that would conclude phase A, and then we go into phase B. And in phase B, we're going to have tests at the low, tests at the highs, and as we go through that, we would be anticipating that the last test is going to be in phase C. So as the price approaches this area, and on that specific day, we are identifying this day as a sprint type action. Please note that I'm not saying that this is a sprint. I'm saying a sprint type action. Why? Because the sprint needs to be confirmed. Well, one of the confirmations came really early on the intraday action. So this is June 22nd. So on the intraday action, we are catching the emergence of the institutional demand. We could see that from the volume signature. We could see that from the price signature as well, where the price dips down and then with the emerging increase in effort, it reverses right away. And the way how it goes up with the expanding up spread is somewhat different than anything that we've seen before on the rallies. So this is suggesting that not only we've experienced some kind of stopping action, but also we've experienced a reversal, and most likely that would confirm the sprint action. And that was the call at that point of time. All right, we'll come back to Bitcoin, and we're going to continue going through this trade. But for now, let's talk about Richard D. Wyckoff. Who he was, what did he create for us, why is this important, and how could we study this and extract some kind of value from the material that he created for us. So Wyckoff lived in a very interesting time. He was surrounded by stock market operators, which operated in a slightly different way than institutions operate right now. The legislature at that time, when he was on Wall Street, let's say at the end of the 19th century and beginning of the 20th century, the legislature was very kind of not so restrictive. And an operator, stock operator like Jesse Livermore or JP Morgan, could accumulate quite significant supply in a specific stock, mark up the price, and then sell it at a much higher price. Right now, in our current market, nobody can do this because that would be considered a manipulation. But there is definitely a herd mentality with institutions that are getting the same type of the research, that are getting the same type of access to all of the companies and management, that are basing their models and assumptions on the same principles. And when they do that, and when this institutional herds kind of creates that type of opinion of the specific asset or specific stock or specific crypto, this is where we could see a very unified actions by the institutions. And that type of body of institutions we're going to call the composite man or the composite operator. And their actions, whether buying or selling, drives the prices and creates the price cycle. I want to point your attention, if you want to know who Wyckoff was, to an unbelievably valuable article to us by Stella Soba. And Stella has presented her kind of view on Wyckoff and who he was, and then she did this second piece in Stocks and Commodities magazines on Wyckoff and Jesse Livermore. And we're very grateful to Stella for coming to us and presenting it to our students in the Best of Wyckoff conference in 2019. Superb article, 5 parts to that, and reads really well. You also could go and find a conversation that Stella had with Bruce Fraser on Bruce's power charting episodes. You just have to go to our YouTube channel and find that specific episode. I would most definitely highly recommend that. So Wyckoff was somewhat of a stock market authority. He was at some point an editor of the magazine of Wall Street. Now, it's a very interesting history that the magazine of Wall Street had. It actually was in existence until, I believe, 1974, when the heirs of Wyckoff's wife, who actually in the divorce got the magazine of Wall Street from him. And I think from that point of view, this was his worst trade, with that second wife, where he lost so much money to her, where he lost so many assets to her. But all of this time before, he was an editor of that magazine. He has created the whole team of writers, and there were quite a lot of articles written on the methodology and how to interpret the price and volume action. And that was foundational for his public course that he published in the early 1930s after. As I said, he was surrounded by different market operators like Jesse Livermore, James Keen, Otto Kahn, JP Morgan, and he interviewed them because he wanted to identify what is it that they do in order for them to be so successful with trading. And he identified and codified specific sequences of how they conducted their bullish and bearish campaigns. And that became the foundation for his work and foundation for his course. He also has been so prolific with other means of communication to the public, where he was communicating his market ideas. So at that time, they had the magazine of Wall Street with a lot of articles in there. You could have subscribed to his newsletter. He also published the Ticker, which was the publication that came before the magazine of Wall Street. In this specific publication, he has the article that was based on his interview with William D. Gann, so kind of pretty cool. And then he authored quite a few books, and you could find those books. They're quite popular. Now, for those of you who are our students, and you're gonna ask me the question, should I be reading those books this semester? My answer to you is no. Those are somewhat outdated, and I want you to read those books only when you graduate to intermediate advanced level. There is nothing in those books for you right now. I want you to concentrate on our course, on the material that I'm going to give you. And believe me, I'm going to give you so much material. You're just basically going to be extremely busy to read anything else. Okay, let's go to the next slide. And this is the original course that was published in the early 1930s by Wyckoff and by his Wyckoff associates. And the name of it is the Richard D. Wyckoff Method of Trading and Investing in Stocks. I believe this course in the public domain, and every time I talk to the SMI, SMI's Todd Barterfield, the company which Wyckoff has created, and for decades, for generations, this company has been transferred to different people, and currently Todd is the president. And I think he mentioned to me that this is in the public domain, so you guys could find it, download it, and read it. Now, this is not necessarily an easy read, but it's a necessary read, again, not for the beginner, but for more of the intermediate and advanced students. So for now, you can table this. You could just find it on the internet, and I will tell you exactly when to read this material. Okay, so let's talk about the composite operator and the whole heuristic. That's how Wyckoff called it. It's a heuristic that he used to identify the force behind the price movement. And look again, this is from the magazine of Wall Street. This is the name of the title, and was written by R.D. Wyckoff himself. And I want to point your attention to just one paragraph. So let's read through this, and let's try to understand who is the composite man and where it could be found. He consists of some 2 million personalities scattered over the face of Earth. So basically, at that point of time, this was the pool of investors, a pool of traders. Some of his component parts are richer, more powerful than others. So who are we talking about here? Probably institutional clients, very rich individuals that have a lot of money. Some are noted for their foresight, intuition, shrewdness, and conservatism. Those are probably analysts that are commenting on the market. And whenever we're talking about the composite man, we usually would be talking about analysts that are on the correct side of the market. Some for the dashing, daring, reckless quality of their moves. So those are usually going to be our speculators that are going to be present in the market, and they're going to be momentum traders or some kind of price cycle speculators. These millions of personalities form one omniscient who sways the market, crushing those who don't know. So this is to the idea that the composite man has a better knowledge and a better execution than somebody who's on the opposite side, and we're going to call them weak hands, and will not learn how to benefit by hand and crying in with profits and income those who do. So the collection of different market participants would create an idea and execute this idea in the market as to what kind of bias we are currently in, and their conviction will be in the commitment to certain positions. And as they create this herd, their buying is very pronounced, and their selling is very pronounced as well. And that's what we want to find on the chart. I mean, our goal as traders and analysts and Wyckoffians is to look at the chart and to find the presence and the signs of institutions, and also to understand where and how in the price cycle the weak hands are going to behave. And I will show you exactly what we will be looking for on the chart to do exactly that. So who would be those composite men? Well, obviously somebody who is going to be influential in the market with their position. So somebody like JP Morgan, the current version something close to JP Morgan would be probably like, Warren Buffett, any type of big hedge funds like BlackRock, PIMCO, and so on and so forth. So all of them together would form that composite man, which would plan, execute, and conclude their campaigns. They would attract public to buy the stock in which they already accumulated a sizable line of shares, and they will be advertising this stock with the uptrend, right? So whenever the price is going up, especially with a lot of momentum, what would happen next? A lot of weekends are going to be attracted to the price moving up, and they will be jumping on board. Brandon is saying, what about the central banks? Yes, central banks have a big role and even a much larger role in our economy right now, because basically they are providing the liquidity which is necessary for the market to advance or to go down, right? So liquidity expands as the Fed gives us more money, as the Fed keeps the interest rate low. So a lot of institutions are borrowing the money at that lower rate. And where do they put it? They put it into the stock market, and that's what they're buying is driving the market up. And this is what we're seeing right now since COVID low, since 2009 low, where there were a lot of QEs being done by the Fed. So absolutely correct, Brandon. Okay, let's go to the next subject. Let's come back to the anatomy of the trade. Let's continue with our Bitcoin analysis. So we said here on this bar that we had a sprint type action. We had this sprint type action confirmed on the intraday of the same bar. And then for the whole time, and by the way, I did open the position right here at around 32. For the whole time, our comment was just one. We need to overcome this level of 36.5. It was important because of this final capitulation bar to the downside. This bar has a lot of selling built in it. So if we want to see a bullish confirmation on the daily chart, we would need to go above and commit in price above this level. So either somewhere here or here or here. But nothing of this kind has happened. And we said that the failure to overcome this will suggest that we're going to go down. Now, the character of the way how the price was going down here was really crucial, because when we are comparing a downswing to a downswing, we want to understand what are the characteristics of the volume and price compared to each other. And we're seeing how laborious this move to the downside is, how the average downward spread is decreasing relative to the previous decline. And that suggested the bullish behavior. So the question was just where it's going to go. Would it go to the lower low, or would it go to the higher low? And we just had to wait and see how that's going to happen. So here's what has happened next. So we're coming into our zone, our target zone, and we're seeing the reversal bar. And this reversal bar, which is a very interesting bar, happens on a much lower volume signature. What does it mean? So the beginners and novice traders will instantly be thinking that demand is diminishing, and this means that there are fewer buyers, and therefore this is a fake rally. And I've heard a lot of this type of comments in the social media as we commented that this is a true reversal. And most likely from here, not only we're going to reverse, but we're going to overcome 36.5, and we're going to come to the 41 to 44,000 area. And it looked to us, if we would just take this type of mini structure or substructure within a much larger trading range, that this was a potential phase C and an attempt to spring the low, the previous spring low. So by that time, with all of the convictions that I saw in this type of price action, I opened up another position right here. So 2 positions, and when I say that they are positions, I mean campaign positions. It means that I'm going to hold to those positions until I see the price not just overcoming 41.44, but until the price overcomes the high at 64, and then even go higher. And I'll show you some of the targets into the end of this session that I have for Bitcoin that not only overcome the 100,000, but actually are showing much higher targets. And I might even surprise you when one of the targets is just going to be way, way out there. So, stick around and see what's going to happen with that analysis. So, but that was the analysis at the time. This was on July 22nd. This was the call. We were talking also about the test bar, that the test was actually quite successful, and we were expecting a continuation. Okay, for our students, and just in general, even if you are not our student, but you still want to study Wyckoff analysis and still be kind of like getting any type of value from our website, go to our bias game. So we played the bias game on Twitter, and we're going to resume the bias game next week. We just had a break over August, summer break. Again, our handle on Twitter is at Wyckoff Analysis. This is where we are posting a chart for you, an assignment chart, and we're asking you to vote. Do you think that this is an accumulation, or do you think that this chart is a distribution? You could see how your peers on Twitter are actually making that conclusion. And then in 2 days, usually on Fridays, we post our solution. And our solution usually contains the labeling and Wyckoff story. This is an explanation as to how do we see this chart? How would we would have to analyze this chart? What are the main important points? So this is a very valuable free educational tool that you could use on the weekly basis. And not only that, in the second course, WTC2, which we call the practicum course, which is only concentrated and we are focused there on skill building. We take the knowledge from the first part, and then we go through a tons of exercises in the second course, and we build the skill of visual recognition, and we build the skill of the execution. And those are 2 different things. I always say to our students, knowledge is not a skill. You might know a lot, and some of you here might be kind of reflecting, hopefully you are, on this type of statement. If you know a lot about trading, and you're still not making money consistently or just making money, this means that every time you're taking the course, you're reading the book, you're basically hoarding knowledge. My suggestion to you would be to concentrate more on the execution and development of the skill. So bias game is obviously one of those tools that you could use. You could also go to our website, wyckoffanalytics.com, and find the bias game there. And you could go to bias game number 1 and go through all of them. We have over 100 bias games. Can you imagine going through all of the bias games, over 100 bias games? It could be a very valuable way to train yourself in terms of Wyckoff analysis and just general trading. All right, so let's talk about our objectives for this segment in September in our course, price structural analysis. What is the main focus for us? First of all, we want to be able to make the correct observations about market participants' behavior on the chart. So when students come to me, what I see a lot are 2 things. Generally, we as people are really bad observationalists. So when we look at the chart, we don't observe enough, we don't observe correctly. And because of this mistake, we go to the next mistake, where we are not making correct deductions about what are the intentions behind big and small market participants. And then because of that, obviously just trading is just off. So we want to trade alongside the smart money, the big money, the institutional money, the stock operators type of money. So observations and deductions are becoming extremely important. And how we develop this logic is extremely important. And this is what we are studying in the first and the second courses. So where would we start our analysis in this course? So price cycle model we're going to discuss today. Behavioral market analysis we're going to start discussing today. Trend analysis to a certain degree we'll start discussing today. I mentioned change of behavior versus change of character. We're going to cover that in the next class. These are true, probably most important and elegant concepts. And, Wyckoff had a change of character as a statement, and I've added to the body of knowledge, change of behavior, and kind of identified it in a slightly different way. I'll talk about this in the next class. What are the nuances of the change of behavior versus the change of character? Change of character is more structural thing, where change of behavior is more the way how the price and the volume behaves. And then we'll also definitely talk about reaccumulations and distributions. We'll cover that in our September classes. Okay, let's start with the price cycle. All right, so this is how the price cycle looks. This is the most simplistic way of depicting the price cycle. And there are four major elements to the price cycle: accumulation, markup, distribution, and markdown. So I'm sure you have seen this numerous times with numerous teachers in numerous classes, in numerous tweets, and so on and so forth. We're gonna, although, talk about those areas in a slightly different way and with the slightly different terminology. So you'll have to pay attention to that. In accumulation area, what happens? In accumulation area starts with the conclusion of the downtrend. And at the conclusion of the downtrend, we have a very interesting event. We are calling this event a selling climax. You could also call this event a stop in action. With this stop in action, two camps of investors are doing a completely opposite things. They exhibit a completely different behavior. Weekends are in a rush to capitulate and sell everything that they have because they've been holding their stocks or any type of crypto assets or futures since certain price levels, and they were not able to give them up. So when the price starts to move down on the increased volume character, increased momentum character, they are trying to get out. What that does, what this capitulation does, is increases the volume signature dramatically. It increases the liquidity, which big institutions are using to create meaningful big positions. And it also drives the price to the value zone, where we've seen that the price is extremely oversold. And the second group, which is the strong hands, are starting to actually accumulate the stock or accumulate any type of asset in the accumulation area. The reason why strong hands do this, and usually by strong hands we're going to refer to them as institutions, but I'm going to make a remark here that Not all institutions are strong hands. And there are a lot of weak hands that are institutional hands. Not only that, a strong institutional hand could become a weak institutional hand. It just all depends on the position. So, for instance, when we would consider Warren Buffett to be a strong institutional hand in the marketplace, but yet he makes mistakes. And I'm so happy that he is so transparent about his mistakes. Well, obviously, there is a lot of reporting that goes into this, but he comments on those. And he admits his mistakes, which is kind of like a very high self-awareness that is required for any type of investment trading type of ventures. So sometimes majority of the time, he has strong hands, and in some instances, like for instance, with this IBM trade that he did, a couple of years ago, that was a losing trade, and he was acting as weak hands. So strong hands starts to accumulate. They accumulate for two reasons. There is enough value for them in the oversold condition, and there is enough liquidity for them to create that meaningful position. That behavior by strong hands, where they basically absorb all of the shares from weak hands that are in fearful mode, in a fear mode, and that are capitulating, stops the price from moving further down. And that's what creates that climactic action. With that type of buying, we're also going to produce the best rally, which we're going to call an automatic rally, and subsequent test, a local test into the climactic action. That three events stop the price from moving further down. And that's what creates the trading range. That's initial stop in action, initial absorption by strong hands. And then the price consolidates in phase B. And we go through ups and downs where the sentiment starts to shift. And there is a strong shift from extreme bearish character and sentiment into somewhat of the indecisiveness between bulls and bears. So the sentiment starts to change. But then going into the later part of the accumulation, we're starting to see a change of character and change of behavior where the price starts to behave in a different way. And the volume starts showing a more aggressive and urgent buying by institutions. And this is the emergence of the uptrend. And this is the time for us to start acting on our positions in any of the time frames, whether this is daily, weekly, monthly, or 60 minutes or 5 minutes, or even the tick data. You're basically gonna go through the same principles as you look through the consolidation and the emergence of the trend and sustainability of the trend and continuation of the trend. After that, once the strong hands accumulated, this is not only going to stop the price from moving further down, it will reverse the price and will start pushing the price into the actual uptrend. Now, the weak hands, being devastated by their previous losses, either in the downtrend or in the or in accumulation area, will be staying away from this particular asset. They just emotionally so depleted and financially depleted that they don't want to go into the stock or into the, let's say, crypto that has produced emotional pain before. So they're going to miss the beginning of the uptrend, but they will become big participants at the end of the uptrend. And this is usually where weak hands are going to become temporarily strong hands, and they will enjoy some profits into the climactic action, which is going to be a buying climax. So at the end, the latest parts of the uptrend are going to have some kind of speculative characteristics. This is where the price is going to start accelerating, and that's going to attract even more weak hands, and they're going to provide, again, liquidity to strong hands, and specifically CO, to start selling and to start distributing the stock. And that's going to happen in the zone which we're going to call an overvalued zone. And with that, the uptrend is stopping. And that stop will start producing moves up and down. And that's how the distributional range is going to be created. As the institutions are observing this type of the behavior, let's say through several quarters, an institution will think in terms of quarters. They don't think in terms of 1 day, 60-minute bar, or even a weekly bar. They think in terms of quarters. Let's say if for the duration of 2 quarters, you're going to have the deterioration in price and deterioration in relative strength. They're going to exit this position or they're going to trim this position. And these exits and trims are going to produce more and more volatility, and that volatility in the price will start showing to us signs of weaknesses, which are going to be followed by weaker rallies. So at this point, we are observing the emergence of the downtrend. And this is where we absolutely need to give up our positions, if not earlier. And we'll talk about how to be efficient with our exits. We'll talk about how to exit on the climactic run, how to exit on the change of behavior, how to exit on secondary test along the trading range. So this knowledge will be given to you. But your catastrophic exit is going to be after the determination of the sign of weakness, and also the last point of supply. This is the weak rally that I'm talking about, and then confirmation by the continuation to the downside. And that's the whole price cycle. So the price cycle is based on the psychology of strong and weak hands. The price cycle is based on the availability of the liquidity for big institutional hands. It's also based on the value proposition to those hands. And it's also based on just trends that are, again, being sustained by what? They are being sustained by the presence of institutional buying and selling within the uptrends. If institutions are still holding on to the supply and not presenting this supply to the market, the uptrend will be sustained. If institutions are starting to distribute their supply of a specific stock, then the demand will start to deteriorate, the price structure will start to deteriorate, and it will start showing some sign of weaknesses. And this is what we are looking for on the chart. We are looking for those signs. We are looking for the clues as to what the big money is doing. So here is a more detailed look on the price cycle. And I've mentioned to you several terms. So for instance, a stopping action in phase A. And please don't worry about the terminology for now, especially for those of you who are new to Wyckoff methodology. This is going to be something like, phases, some kind of events, and so on and so forth. We will study this, and I will most definitely go into the depths as to what this is, why we're using it, and how we would benefit from it. But for now, I want you to remember that the first price volume action in the consolidation is going to be in phase A, and it's going to start with the final climactic run to the low, and is going to be followed by the best rally in this downtrend, which we're going to label as the change of behavior type of rally. It's here where a lot of trading decisions by us should be made if we are shorting the downtrend. This is usually the clue for us that we should be getting out as the trading range will start unfolding. Well, after that, we're going into the preparation mode in phase B. So again, phase B is very enigmatic in the way of how the price behaves there. We are seeing a lot of ups and downs, a lot of volatility, and we'll talk about the characteristics of phase B. Then we finally go into this phase C. This is the final test of the supply at the level of the support. If this is successful, then the next rally, which is labeled here as a sign of strength rally, should show to us that for the second time in the trading range, we are observing a change of behavior. And this change of behavior is the best rally that we have seen in the trading range, which is being followed by the best reaction in the trading range. And that's this reaction together with the rally is going to define the structural change. For the first time, we are going over the resistance and we do not come back into the trading range. So a change of character is happening, a structural change of character is happening. And then we are in the uptrend. And then to the conclusion of the uptrend, again, the logic behind accumulation and distribution will be somewhat the same. We will be thinking about first initial stop in action. We will be thinking about how in phase B we're going to have buyers and sellers and how the sentiment is going to start shifting. And then as we come to phase D, we're going to observe a sign of weakness, last point of supply rallies. And this is where we're going to start seeing deterioration in the price structure. And the conclusion of that will be the development of the downtrend. Of course, the actual market action is much more complex. And we could see that from the original accumulation, the uptrend is going to develop in multiple steps. We could have quite a few stopping actions, which we're going to call these pauses reaccumulation, stepping stone consolidation ranges. And the development of those is going to have the same mechanics as the development of the accumulation range. We are going to go through the phases of stopping action, where the uptrend is temporarily stopped on profit taken by institutions. We're going to go through the preparation phase, and then we're going to go through the change of behavior phase that would indicate to us that the price is ready now to go into the next upswing, to go into the next uptrend. And again, conclusion distribution is going to have also the same mechanics as any type of redistributional structures that we're going to see on the way down. And then again, the downtrend is going to conclude with the stop in action and so on and so forth. So as you could see, all of the elements or phases or events in the trading ranges are going to have a repetitive nature. Yet, we're going to have different variations on the looks as to how those trading ranges might look. Some ranges are going to be much stronger structurally, and some ranges are going to be much weaker structurally. And that's what we're going to study as well. So here's an example of the price cycle. This is Apple, and this is a monthly chart. And by the way, somebody was asking me a question. Do you only look at the stocks? No. I actually trade. I trade cryptos. I trade futures. I trade stocks. I trade options. So a Wyckoff analysis could be applied to any assets with the price and volume, or even just the price. You could make your analysis just based on the price. And it could be used for any of the timeframes, whether we're looking at the monthly, weekly, daily, or any type of intraday, including the tick data. So in this example, we're seeing a very much long-term causality, which is going to be a secular causality. Ironically, this secular causality is still playing out. And it's just amazing how it's still there. It's still the primary cause of the whole move to the upside in Apple. And it's so obviously being associated with 1996 when Steve Jobs comes back to Apple and produces the mentality and creates the product line for the next, almost generation. And Apple is still, following that plan. And that's how the whole secular move is still so sustainable. But obviously, it is sustainable also behind the presence of institutions. So the key question for us is to identify that presence on the chart. How would we do that? Well, look at this volume bell curves that we're seeing. What do you think is happening here? Who is buying or selling during this period? Well, first of all, we want to identify whether the buying or selling has happened. And we're seeing as the price advances, most likely this whole increase in the volume signature is being associated with buying. If this is associated with buying, who would have had such a high volume signature of, let's say, several billion shares? Would the retail people have that type of power? Most likely not. Would the institutions have that type of purchasing power? Most likely yes. So behind the increases of the volume signature, we usually will be identifying institutions that are interested in this particular asset. They're coming in and holding on for a long time positions like Apple, just because this is kind of like a very systematically structural company for the economy in general, and this is where institutions want to be present. Now, please note that their buying has been concluded most likely somewhere in this zone right here by 2014. Everything else, so imagine how they are accumulating on the way up for what? For over 10 years. That's a significant accumulation on the way up. After that, they are just holding. And that's why the volume signature here is so dramatically lower after 2014. They're not selling. They might be profit taking here and there, but they are not selling it. They're not distributing it, and they're holding on to the stock even now, as Apple even today has made that new all-time high. Okay, let's come back to the Bitcoin. And I'm trying to go fast because, again, we've got a lot of material here. Maybe at the end, if we have time, we'll try to figure out any type of questions that you have and just to go through those. Okay, so we've talked about, and this is a 4-hour chart on Bitcoin, July 26th. And what I'm showing you guys are actual tweets that I did during this period. We said that our entry point was somewhere here. Our entry point was somewhere here. So 2 points of entry. So the first one was on the premise of the spring that was a lower low below the local low here in phase B and also below the selling climax. So a spring type action at least warrants some kind of trade opportunity. And then the second point of entry, we said that came on the background of the bullish reaction. It also suggested that not only we're going to overcome this line right here, this red line, which is 36.5 or 36,000. And look how it goes through. There is so much conviction in the volume and the breakout itself, which is, again, very suggestive of the bullish bias, and that actually was a confirming bullish bias. And at this point, when this tweet came out, we're basically saying that there is still some supply behind that strength, and most likely we're going to be in some kind of consolidation here between 34 and 41. So what valuable information that comes to us from the supply signature and from the price action that we could not only expect some kind of pause, but we also could expect some, during this pause, we could expect some kind of add-on opportunities as well. And we are seeing that around this area of phase C for this trading range, we are seeing add-on opportunities. We're also seeing that in phase B, there's a lot of price structural strength where the price overcomes the resistance, where the price creates upsloping structure, where the price in phase C cannot create a lower low and instead creates a higher low. So again, the whole trading range is confirming the bullish scenario, and we are adding to the position in this type of trading ranges, and our expectation is that we're going to next overcome the next resistance of 41 to 44. Okay, let's switch gears again. I'm going back and forth to the anatomy of the trade. Again, at the end of the class, I'm going to show you something really, really funky about the Bitcoin. So stay tuned. Behavioral market analysis. So what is it? It's the studies of market participants' behaviors in the context of the price structure. So this is not necessarily something that was defined before. This was not defined by the Wyckoff. This was not defined, let's say, by SMI or Golden Gate University or anybody. This is just me trying to combine the psychology of market participants together with the price structure, how it unfolds. And again, we're coming back to the price cycle. And the whole idea for this slide is just to identify who are the market participants. And obviously, we've talked about the strong hands and the weak hands. And we want to understand where the strong hands and the weak hands are going to operate and how they're going to operate. So at the conclusion of the downtrend, we're usually going to have an extreme point of fear, and we're going to see the capitulation by weak hands. We've talked about this on the climactic action. We also will see the first signs of intelligent accumulation by strong hands. This is where, again, the volume signature increase, not just because weak hands are giving up their position, but also because institutional hands are actually establishing meaningful position with big size, and because they have such a long time horizon, they are willing to hold on to this position throughout the whole accumulation range. And in some instances, it takes a year or even more to go through their accumulation, and they're still willing to hold on to this. So that kind of tells you a lot about the character of strong hands and specifically composite operator. In the area where the uptrend starts to emerge, we have another group of institutions that are starting to jump on the trend. We are going to call them institutional trend followers. And at this point of time, when we are observing a change of character that is preceded by the change of behavior, this type of action is being codified in a lot of institutional models. So imagine that a lot of institutions have maybe different type of tools, but their tools are identifying the same market event, which is the emergence of the uptrend. And with different tools in different ways, institutions are seeing that something has changed throughout the consolidation, and now the uptrend is starting to emerge. So they start jumping on this uptrend, and they start their accumulation on the way up. So if CO has been actively accumulating during the consolidation itself, the institutional trend followers are going to start accumulating only at the point where their models are going to show that change of behavior and the emergence of the uptrend. What this does, it adds to the buying power, and that sustains the early uptrend behaviors of the price. And that pushes the price away from the trading range. As we go through the uptrend and we go into the first signs of the distribution, we see that there is an extreme point of excitement by weak hands. And we'll talk about how to identify those, how to see those on the chart, how to actually act during those times, what would be our tactics. And at the same time, as I said, this is going to be the place where we're going to observe also the first signs of intelligent distribution by strong hands. This is where we're going to see the volume spikes, and after the climactic run, sudden stop in action, followed by a very sharp reaction, which is a change of behavior. as we go through the trading range, distributional trading range, CO is going to keep selling into strength. And then in this last quadrant, phase D, we're going to see that institutional trend followers are going to start identifying the emergence of the downtrend. And this is where we're going to observe a change of behavior and a change of character. And this is also the zone where we want to be extremely active, where we're going to establish our positions, because the price action and behind which is the institutional behavior is suggestive that the uptrend is not only done, we went through the distributional consolidation, and now we are in the emergence of the downtrend. So we should reorient ourselves to the downside. Simon is asking, does it mean that the CEO does not participate in marking up the stock? No, not necessarily, Simon, right? We're going to talk about reaccumulations. Let me kind of come back to this slide. And specifically in these zones right here, we're going to have a lot of the CO plus institutional trend follows type of actions where there is exchange of shares, because some of the institutional trend followers are going to have some profit taken, or the CO is going to have some profit taken, and some other institutions are going to pick up those stocks. As well as here on the final test, there might be an increase of the volatility, which could bring other institutions to the same position as they see that liquidity is available and there is some short-term value proposition. So CO is still going to be somewhat active, but not as active as in their accumulation. But predominant theme by the CO is going to be most definitely accumulate in their original accumulation, and then take some profits along the way and hold on to the asset until the overvalued zone, and this is where they start selling into the strength. Okay, thank you, Simon. Good to see you back. Okay, price cycle in terms of the idealized behavior by strong and weak hands. So we talked about CO being extremely active in the accumulation area. So this is where CO is buying as the price falls. The second stage by the CO, which is going to be at the institutional trend followers hand, is buying on the way up. This is the emergence of the uptrend. And then they're going to stop. They're going to say that we bought enough, we have a full position on. The price has extended somewhat, so the short term there might be some, overvalue, some kind of, conditions that would dictate some temporary change of behavior, maybe a reaccumulation, maybe a decline to a certain degree. So they become inactive in the second part of the trend, and they just kind of enjoying this ride. And they start selling as price is going to overvalued condition, and they start taking profits and they start distributing their stock, and that's what starts creating that distributional area. And they are selling on the way down as they are capitulating at the beginning of the downtrend. And they will not be selling on the way down into the second part of the downtrend. They would be completely done. Now, weak hands behave differently. It's almost like the opposite of strong hands. They are selling by capitulating in the final final segments of the downtrend. They are selling as the prices rally in the downtrend, as their sentiment is still bearish and to the downside. And then they go away. And the reason why they go away, and I mentioned this before, is because emotionally they become exhausted, and financially they are becoming depleted. So they don't want to participate anymore, and they become inactive. They become extremely active when the trend has advertised itself, and the trend is in a more speculative phase. So they are buying on the way up into the climactic action. And they're also seeing a lot of value as we go through the distributional range. So every time the price goes to the support, in their mind, this is a good time to buy, because if the price was acting so well before in the uptrend, then they are expecting continuation and kind of the same type of uptrend. Obviously, in the distribution, this is erroneous, and after a deterioration of the price structure into the sign of weakness and weak rally into the last point of supply, um, they are will be still unwilling to depart from this position. And as the price starts to break to the downside, the hope kicks in, and they are saying, like, let me just hold on to this. And I'm sure that all of us have been in that situation. We just need to recognize that sometimes we act this way, and we just need to learn to identify correctly the bias of the consolidation and be more in the mindset of the CO, be in the mindset of smart institutional money. Let's look at the example of the same schematic. So this is strong hands. What do we see here in Apple? We're seeing from the volume signature and the price increase that the institutions were buying on the way up. Prior to that, we're seeing some CO type buying on the way down. The market has derailed Apple from concluding the sign of strength and the backing up action at the higher level, and that produced a high volatility event to the downside. But that still created a higher low, which was very interesting, and that suggested the strength of Apple at that point of time in 2000, 2001, 2, and 3. When the market was going down, Apple was consolidating, so obviously a comparative strength there. And they were buying on the way down as the price created some value proposition after this strength. They were saying, okay, well, there is a lot of liquidity that market provides, and there is also oversold condition, a deeply oversold condition relative to the strength that we've seen before. So they became the buyers there, and then they started buying on the way up. And this buying on the way up is associated with the institutional trend followers. So again, their models not only going to identify the strength of the trading range, but it's also going to start identifying the emergence of the uptrend and the emergence of much larger uptrends. So that's why we're seeing such a big volume increase. And then that buying by institutions are going to continue. As I said, I think that it stopped in 2014. And then what? They become inactive. They just holding on to this position as the price goes up, but they don't have to do anything. They just need to hold on. And as long as they don't present all of this volume, all of the shares to the market that they bought throughout those years to the actual marketplace, then the price will still gonna go up. The price can go up on lower demand signature if supply is controlled by strong hands, and that's kind of like a big piece of information that we will be working on throughout this semester. Let's look at the lower time frame. This is a weekly chart of Apple. This is 96, 97, 98. Again, Steve Jobs is coming back, and this is this was the cause for this particular rally, and this was also the cause for this major sign of strength. But in terms of the price cycle, we're seeing that there is quite a lot of buying by institutions in the trading range itself, especially in this area. And they are buying as the prices are falling down, either falling down in the downtrend or falling down in the trading range. They are also buying on the way up. Again, we could see this in the volume signature. All of those increases in the volume, we call them the volume spikes, is suggestive that institutions are actually creating this volume signature, because retail people cannot create such a substantial volume signature. They cannot buy so many shares. And then if institutions are the buyers, that drives the price crazily up. And that's what we're seeing. So they are buying on the way up, and then they become inactive. And this inactivity is being reflected in the diminished volume signature. And then after that, they are capitulating on the way down by selling. And again, this was more of the market-driven event. On the daily chart, you're going to see a big gap here, for those of you who know history of Apple well. And they were basically shaken out of this position by the market, by the 2008, by the 2000 bust of the technology bubble. If we go to even lower time frame, we could also find price cycles. So this is just to show you guys that price cycle, you can find the price cycles everywhere. You could on any time frame and in any asset, and you could identify institutional presence even on the lower time frame. So look at this. As the price falls into the climactic action, we're seeing that the volume is expanding. So what does it mean? It means that somebody is coming in, starts to buy as the price goes down, and that stops the price from further moving down. Next buying, again, on the way down. And then next buying, as we're seeing the price advance on the way up. So now we're seeing that institutions are not only buying on the way down, but also on the way up. Then they become inactive. Some profit taken here. We see that also in the volume increase. And some distributional characteristics as well. Not that visible yet, but as we go up, again, we're seeing how in this area right here, volume signature is increasing, and we see after the gap, the price actually goes down. So what does it mean? Did they buy or did they sell? Most likely they sold, because volume has increased, and yet what did the price do? It went down. So they are selling, and then they are selling on the way down by capitulating. So each time frame or in whatever effort will have that price cycle built in into the consolidations, uptrends and downtrends. All right, let's talk about different market participants. So I've mentioned to you the CO, and I mentioned to you institutional trend followers. I also have mentioned to you retail people, and retail people like ourselves could be both strong hands and weak hands. And we're usually going to, depending on the position, be either strong hands or weak hands. So I'm not necessarily alluding to the fact that retail people are always traders, are always weak hands. And I think it was erroneously stated in the methodology 100 years ago that retail is always going to be weak hands. That's not true. I've seen a lot of traders, and a lot of traders, and you've seen it from your own trading that there are quite a lot of strong hands on the retail side. So as there are quite a lot of weak hands on the institutional side as well. And that just depends all on the positions that we have or they have. Okay, so CO, we're going to call CO an institutional contrarian investor, somebody like Warren Buffett, where he comes at the point of extreme oversold, undervalued conditions. And the methodology that this type of investors usually use is a value methodology. Their size is huge, and that's their advantage. And their time horizon is secular to cyclical. So they're not going to look at the intraday. They're not even going to look at the daily chart. They're going to mostly look at the weekly, monthly, and quarterly charts because that's their time horizon. They are looking for the long-term value, and they're looking for the short-term liquidity, like the climactic action, to get their sizable position on. And they're always looking for the contrarian sentiment. Why? Because it's during the contrarian sentiment, the weak hands will be willing to give up their shares much quicker and in much larger quantity, and that's exactly what the CO needs. Their limitations are going to be that they're too big, so they're not that quick. They need to have low turnover. So whenever investors give them the money to manage, investor does not want to see a high turnover of the portfolio. So volatility of their portfolio is extremely, extremely important. So the requirement to the institutions and to money managers is to have a low turnover. And also they will be very cognizant of any tax implications on the positions that they have in their portfolios. So their preference is to have be taxed based on the long-term gains, which is more preferential, rather than on the short-term gains. And that always changes, even here in the U.S., right? So maybe it is less relevant right now for institutions, but it was very relevant before, and it might become extremely relevant in the future with all of the things considered that the current U.S. administration is thinking. Their edge, the CO edge, is the time horizon. So they have time horizon that is extending and expanding into the full price cycle. So it's years and years and years. And therefore they are looking at the long-term trends. They are also, another edge that they have is they have a very deep knowledge, or they have people, analysts, who have deep knowledge about the market, and they have the deep pockets, to pay them a lot of money and to use that research, for their execution. They will be visible on the chart at the extreme points of volume, at the points of the liquidity, when we look at the trends, and not just the price trend, which is an absolute trend, but also relative trends, and when we look at the long-term volume. Some examples of the CO is Warren Buffett, PIMCO, BlackRock. So those kind of like huge type of investors and investment institutions. I mentioned institutional trend followers. So those are usually going to be your other institutional companies like pension funds, insurance companies, investment banks, mutual funds, hedge funds, registered investment advisors. They still together create a very sizable chunk of money that goes in and out of the market. We're going to mostly think about them as growth investors. So they want to come in at the emergence of the uptrend, and they want to get out at the conclusion of the uptrend. Their size is relatively big, and their time horizons is going to be cyclical. So they want to, for instance, invest at the 2009 low and hold on to that investment into 2014 high, something like that. Then reinvest in 2015-16, and then close position into the 2017 climactic run, and so on and so forth. What are they looking for? They are looking for the emergence of the trends, break of the trend, long-term value, and short-term liquidity. So somewhat similar to the CO, but the difference here is that if the CO is willing to start investing at the beginning of the trading range, and their investments actually create the trading range, then the institutional trend followers are going to be interested in the emergence of the trend. So there is some kind of more efficient way that institutional trend followers have over the CO, but CO is ultimately the rule of the land. They create the structure. Institutional trend followers help to sustain that structure and help to sustain that bias. Their limitations are going to be in the performance matrix. So performance matrix is extremely important because we're usually going to be talking about some kind of money managers, right, in this company right here. They need to perform. They need to create a profitability. That's number one. And they also need to create outperformance. These are the two parameters by which they are being judged by the peers and by their clients. If they cannot produce, they will not receive the money. If they underperform, they will not receive the money, or they will receive less. So performance matrix is extremely important. And because of that, their behavior is going to be specific. They will act in a certain way. Assets under management is also that one limitation where in order for them to get more assets under management, they will have to behave in a specific way. And we can use to our advantage, understanding why they behave this way at the specific structural spots. They are also, as the CEO, concerned about the low turnover, and they're concerned about the long-term tax implications. Their edge is still in the time horizon because it's cyclical in the long-term trends, which are more sustainable than shorter-term trends, and in deep knowledge. So they still have enough money to hire any type of market professional and any type of market research, and they train their personnel to behave in a specific way, and they build their system in such a way where their traders behave in a specific way. They are visible on the chart based on the absolute and relative trends, on long-term volume signature, and also on the momentum signature as well. We could see on the charts the price expansion in one way or another behind the volume expansion. And with that price and with the result expansion, there's going to be a lot of momentum characteristics. Okay, let's discuss the professional traders. So those are going to be medium to small size traders. They could be individual traders. They could be registered in institutional advisors that are between 1 to maybe like 50 million in assets. They are retail traders or any type of proprietary traders. Their time horizon could be daily swing and intraday. Those are more retail type of time frames, and somewhat over part of the I should insert here part of the business cycle type of moves for more institutional, like registered investment advisors. They're looking for short-term overbought, short-term oversold condition, and short-term momentum. Their limitation is that they're making too many trades. They have a high commission, although this is not relevant anymore. And they have short-term taxation limitations, and they have lower size for their trades. But their edge, as our edge as retail traders, is quickness, in and out, without even producing the movement of the price. When the first two market participants buy or sell, the price moves. When us buying or selling, we're not going to produce that type of moves, especially in like big, large cap stocks like FANG stocks and so on and so forth. They are visible on the chart from the momentum signature, from the short-term volume signature, short-term liquidity, and short-term swings. And then the retail trader, which we already mentioned here. So again, usually momentum, small size, daily swing to intraday, looking for breakouts, some points of excitement. That's kind of like a very, very common thing for the retail traders to do. Very sentiment driven, lower knowledge usually, and extremely lower skill compared to, let's say, institutional traders. And this is why you're here, by the way, guys. The reason why you're here in this session is because there is somewhere unconscious thought that is sitting inside of you that you want to improve your trading and you want to make money with those improvements. So make sure that you increase your knowledge base, the proper knowledge base, not everything that you need to know. Majority of you, probably 99% of people in this class today, already know enough to make money. You just withdrawing yourself from skill building, and this is exactly what in Wyckoff Analytics classes we are doing. We are pushing you to build the skill rather than to hoard the knowledge. The edge is obviously the quickness and different rule definitions. Visible on the chart, not so much because of the size. And example of this is us, retail traders. Although I have to put myself right now into two categories, as I'm also managing the money in a hedge fund, in an alternative investment fund. So I'm here and I'm here. Okay, let's continue. So we've talked about how complicated the price cycle could be if we're going to go into much finer details. I just want to point your attention to a couple of spots in the price cycle, and specifically a couple of spots in the consolidations, whether it's an accumulation, reaccumulation, distribution, or redistribution. It's phase A and phase C and D. This is where there is the majority of the exchange of shares happens, from weak hands as they sell into the climactic action to the value buying at the lower parts of the trading range, and where the trend followers are still, institutional trend followers are still inactive. Then in phases C and D, we have weak hands still being inactive because they are just exhausted, and value buying is still continues, and now trend following institutions are joining the party, and that pushes the price up. And then in the reaccumulation, as in the redistribution, also these two places are extremely crucial and important for us. We could be seeing some weak hands buying where the CO, the value investors, are profit taking, and the trend followers are buying as well, or profit taken. So in phase A, we usually will have the increase of the volatility. And it's kind of an interesting idea because when I was taught this method, I was taught that during the reaccumulation, we're going to have kind of like the whole range devoted to the exchange of shares. Not true, or not necessarily true each time. We could have the majority of the reaccumulation where, let's say, profit taken from institutions is being allocated to trend followers that are willing to absorb this supply and wait until consolidation is done and then participate in the continuation of the uptrend. That's a big distinction right there, in which we'll go into more details later on in the course. Okay, I think that's it here. That was the main idea. Let me see a comment from Ross. Ross, good to see you here in the class. Apple value of trading February to March of 2020 has a historical high, twice the average value of trading since 2013, the best opportunity for institutional players to add to the positions. Yes, so along the way, institutions will most definitely add to their positions. And that's how they also will be supporting the reaccumulation type of ranges, right? So because they could say, once they see some kind of short-term value proposition, let's say in phase C, just because there is a short-term also liquidity, they're going to come in, and the CO and the institutional trend followers could add to the position. Absolutely. And that's what stops the price from going further down, reverses the price, and then sustains the uptrend. And the price is being pushed out of the trading range. Okay, let's look at the example of this. So we're seeing Apple daily chart. This is 2011. We're seeing a couple of trading ranges which are stepping stone trading ranges. And every time the price would go down in the trading range, we would see some kind of volume spikes. What are those? Those are buying and selling at the same time. So somebody is buying and somebody is selling. Because the price went up after that, we know that the smart hands are buying. So therefore, all of those volume spikes has presence of the demand. And as Ross pointed out, during the uptrend in reaccumulations, those COO types and institutional trend followers will be buyers. So COO types are usually will be buyers as the price goes down because they like value. And we are considering them contrarian investments. So they are buying when everybody's selling. The institutional trend followers are going to be buying on the way up. So we see an increase in the volume signature when the price leaves the trading range or overcomes the resistance. The same happens again throughout this trading range. The same happens on the way out when we see the emergence of the institutional trend followers, which are momentum traders at this point of time. And then we was definitely going to see in the distributional range the CO coming in, the value investors are producing value selling. So they are selling where they're taking some profit, and in their some kind of either short-term or long-term horizon, they could foresee that the price will go down for a certain period of time. So they're taking advantage of the extremely overbought condition. As they sell, the price produces that meaningful change of behavior that suggests a trading range. And our goal in the trading range, again, three things that we want to figure out: the bias, timing, and the character of the next move as the price comes out. Now, this was a very difficult trading range because above the resistance range, the price overshoots into the upthrust after distribution action significantly, which is still a bullish indication right here. And also, it was a difficult trading range because of this area right here in phase B. Usually, phase B would be discussed as the course building. It's not just that. And I will show you in our classes that it's also about the exhaustion of the supply and demand that came on that profit taken. And as we are seeing price coming back into the trading range, this is the area where we're becoming concerned because the supply signature is increasing, and also the price starts to deteriorate and is coming back below the resistance and into the trading range and starts to retest the lows. So this is a change of behavior as well on the opposite side. And here we would be thinking about, well, first of all, exiting the position and also establishing some kind of point of entries for our short positions. That's what we would be thinking about here. Okay. Let's come back. Okay, we're at 5:13. Perfect timing. Wow, how did I do that? Okay, let's come back to our trade in Bitcoin. So as I said, two positions that I've opened here. These are my points of entry. Number two, PO to number one. I'm purely operating here from the assumption that I'm a long-term investor in Bitcoin. I do believe that crypto space will become so crucial to us in the next 20 years. And specifically, Bitcoin will be, extremely important for this process. My time horizon here is years and years and years. Having said this, you could obviously trade it as well. And throughout the whole trading range, I could show you some of my intraday and swing trades where, for instance, I have some trades to the downside like this. I had some trades to the upside, basically a trading range trading. But what are we discussing on August 20th as the price already has created a minus sign of strength by overcoming this very important 36 and a half level, and then as it created the minor backing up action after that, and then by overcoming this resistance. And remember, we said when we were discussing this price action right here on the intraday level, that the rally is so strong. Supply is coming in on the up bar right here. We see this from the supply tail and from the volume signature. And yet absorption happens almost immediately. The test of that is also very favorable. So we said that not only we're bullish, but we know that the price is not going to retest the support anymore. And more on that, we're going to actually overcome 44,000 resistance. And we did exactly that. We went into the major sign of strength, which is basically by the definition overcoming of the resistance cluster that was created by points of resistance in phases A and B. And then we consolidate by not returning into the trading range or significantly returning into the trading range. That's exactly what is going on at the time of this tweet. So my assumption was that we are going to continue going up. We are stolen here, right? So we are somewhere here right now. And I think that it's possible for us to see some kind of spring below 46 or even going into 44. But the whole idea here is still the same. We're going to go into this target zone that was defined by the selling bars in this reaccumulation / distribution structure. Because again, to me, there are two structures here, not one. Distributional structure and then reaccumulation structure right here. And we're going to have some kind of stopping action as a buying climax, change of behavior, and then we might consolidate here. I might be wrong about this, and it doesn't really matter. I mean, like if, for my position, even if we go up like this, or if we go down, consolidate here more, and then go up, my investment positions are not going to be changed. If anything, if we have another opportunity, I would add to the position. If anything, I would be aiding on any type of breakouts. And if we create this type of trading range, I'm still going to be adding to the position. That's where my conviction is about Bitcoin and just cryptos in general. Obviously, you have to be extremely selective with cryptos. Not every crypto is going to go up significantly. So that's very important. Simon is asking, major selling bars to test, are these just large down spread, or do they need to have both large down spread and increasing volume signature? Very good question. So my preference is both, and we see that both the volume is increasing and the volatility or the downward spread is increasing for those. Okay, so what happens next? My tweet today, the 30th. I said in the tweet that the most fascinating aspect of the Bitcoin chart is not the vertical chart. It's the point and figure chart. And we are not necessarily going to be studying PNF horizontal counts, which Wyckoff methodology is so unique and, you know, it's just like a whole different method of how you would look at the targets. We do have, for those of you who are interested, we do have some on-demand classes on those, so check those out. But basically, the whole idea is that the cause is going to produce the effect, and the relationship between the causality and the effect is going to be one-to-one. So as we are measuring the most conservative cause here in the trading range, that was created in 2018, 19, and 20. So go to the vertical chart and look at that period of time. I'm identifying the stop in action, automatic rally, secondary test, last point of support, upthrust action. It's a trading range. It's just somewhat hard to see the structure there. But on the PNF, you could see the structure really well. So as we're measuring the causality, the most conservative causality, our accounts are showing 31,000 to 46,000. It's a range where we would be expecting the price to come and then have some kind of stopping action as a buying climax. And after this stopping action, we would be assuming that there's going to be some kind of trading range, supposedly reaccumulation, to be confirmed or to fail. And as we were going through this range right here, we're thinking that now we are ready to start moving out of the trading range, and that would confirm ultimately the reaccumulation. So we stopped exactly at this area. We don't have to measure, to the last column. We just measure in the area of where potentially we could have change of behavior, reversal, stop in action, and so on and so forth. It worked out perfectly. This second count is an aggressive count. This second count goes to the climactic action from the last point of support. This is our count line right here. And it counts to over 100,000. And I've been saying since February that most likely we're going to see 100,000 by the end of this year. I'm not sure whether we're going to go there after such a decline that we've had, but at least I think in the first quarter of 2022, we might be there. We might overcome 100,000 and we might be in this range. So another consolidation might happen there, and it could be as aggressive as the one that we've currently had, where we have like this 50% decline. And that's just the nature of the beast. That's just the nature of the Moby Dick, that is the Bitcoin. It just does that. And if you're a long-term investor, you should be accustomed to this type of volatility. But here's the funky part that I've been mentioning throughout the whole session. The super aggressive counts are leading us not just above 100, but above 1 million. So it's kind of shocking to think that this is a possibility. Wow, 1 million for the Bitcoin. Could we get there? I don't know. We'll have to see. The price is the king. The price action is the king. So even though we have targets, until we actually in the trend overcoming these targets and then the price confirms continuation of the uptrend, we cannot even talk about this. But I want to have that shocking effect on you that a lot of the counts, those long-term counts that we had throughout the years, starting with Hank Pruden's counts at Golden Gate University, where he, in 2010, identified the target for when the Dow Industrial was like at 9,000, I believe, and he identified the target of 17,000. Nobody believed him. And yet, after a while, after years and years, the price goes there, and then everybody accepts it as a common thing. And Hank gives another count, of the Dow Industrial 30,000 at that time. Well, it wasn't really Hank; it was us, together. But it's hard to comprehend those type of numbers when you're coming out of the bearish sentiment and when the price is still so far away. But it could happen. And I just want to bring your attention that there are much, much larger targets here for the Bitcoin. And then a reaccumulation, which on the PNF is acting as a backing up action to the major sign of strength, to this consolidation right here. So it's a huge formation, but it is possible to assume that it's all a part of just like one formation right here. And the major sign of strength, the way how it developed and how overextension above the buy and climax has happened, suggests that there is still a lot of strength for Bitcoin. So we'll have to see how that's going to unfold. Okay, well, that's it for today, but let me finish with one last statement. For those of you who are already students in this class, please do not forget your homework assignment is mandatory. I want you to read Jim Forte's Anatomy of the Trading Range. This is a very important foundational article that we have to go through. And to a certain degree, we'll talk about it. Secondly, for those of you who are new to Wyckoff Analytics and you guys are thinking like, yeah, this is it. And usually you should be feeling it inside. I remember the first time I came to Golden Gate University, I went to Hank's office and he showed me Wyckoff charts and he started talking about this. He had me in the first 5 minutes. I already knew I'm going to study this. This is me. This is very logical. This is flows in my head. I could operate that, but I need the knowledge and I need, my skills to be built to such a high level where execution is seamless. So if you are having this type of thoughts, if you are thinking this way, then register and we'll get to work. And we'll start going through a lot of materials and we'll start going through a lot of exercises and homeworks. So if this is you, I want you to be in this class. And my promise to you is that we're going to make sure that not only you're going to receive the knowledge, but you'll know how to implement this knowledge in the marketplace. And usually after 2 or 3 months, students come back to me and they say, like, I see the market in a different way right now. It's not necessarily that their trading has improved right away. It takes time. It takes time to build the skill. But the most important step is the first one. So this is the first step. And with that, guys, let's see if we have any type of questions. We are at 5:27. Amazing timing. So let's see what else we have here in terms of the questions. Okay, I'm not going to read the name, but I'm going to read the question here. Is there supposed to be some type of confluence between the PNF targets and Fibonacci targets? Very interesting question. And I've never thought about it this way, but obviously the more confirmatory signs you will have using even different tools, the better, right? So if the fibs are going to show to me that there is an overextension to a specific zone, price zone, and then the PNF confirms that, I would most definitely give more meaning and more weight to that type of target zone. Okay, what else? I don't think I'm seeing anything else. Okay, what is your historical win percentage using Wyckoff? So I would say that if I would take all of my trades, I would be above 60% plus, so somewhere there. Definitely not in the, kind of like 70, 80, and 90 percentile. And this is not my goal. So if I'm producing 60 plus, and this is over time. So you're gonna have years where you're somewhat higher. You're gonna have years, especially at the beginning of my career, I had years where I was losing money. So you have to go through that education. You have to establish yourself. But let's say that if you're at 60% and your, let's say, average win to loss ratio is going to be at the minimum at 3-1 or at the maximum of, let's say, like 10-1, then you're going to make money. And especially with trades like this, where you have such a discrepancy between the average win over the average loss, you could literally be wrong 9 times out of 10 and you could still make money. This is just how it works in terms of the averages. I've seen results, much better results, and I'm giving you obviously 60%. This is 25 years plus average for me. I've seen some people with the results much better, so somewhere 70 to 80% percentile, and usually those are going to be your intraday traders that are very mechanical in the way how they trade. I've seen some long-term campaign traders that could have years that are much better than 60%. I'll give you kind of like my hedge fund numbers for the last 2 years. So we started in 2020. So our 2020 was 46%. we're outperformed, and our 2021 is in line with the market right now. And I really would like us to get the push into the end of the year, so where we would outperform. So, Sean, hopefully this is covering it is enough and gives you sufficient information as to where I am with that and what to expect. Another comment, again, not gonna read the name because I might mispronounce this. To practice timing, what type of practice exercises would you suggest? Like to identify bias, the Twitter bias game is a very big help. Yes, so for the bias identification, go and practice the bias game. For timing, we have the exercises that are in-class exercises. So I can't really point you to a specific exercise which is free. Because in my mind, I think that knowledge is kind of predominantly free. You could find a lot of information on Wyckoff methodology on the internet. It's just that it's not going to be taught to you the same way how we teach it here. Also, we have expanded knowledge and more advanced knowledge, so that's also most definitely an advantage of being a student of the Wyckoff Analytics. But in terms of the timing, those are going to be exercises that we're going to practice in the practicum. And the practicum is the WTC2 class. So we would look at the chart, look at the trading range, and as we go through the trading range, not only we're defining the bias, but we're also measuring the timing when the price is ready to start moving. There are certain characteristics how the price behaves, which is also going to be coinciding with the absorption of the supply. And I think that's the much that I would like to say at this point. Okay, from Samuel, what broker do you recommend to work in the US? So I'm not going to necessarily recommend something. I'm just going to tell you what I'm using. So for my brokerages, and obviously for the hedge fund, we are using institutional brokers. And then for, let's say, retail brokers, any of the large retail companies like Schwab, TD Ameritrade, those are all great. I'm using TD Ameritrade. And I'm also before used Interactive. I'm not really happy with Interactive, just I think there is a little bit of a learning curve for the user interface. So I didn't really like that. I literally, for my personal and IRA accounts, I trade off my phone on TD Ameritrade. And then in terms of the softwares that I use, or that somebody would ask me like, what software do we need for this course? You don't need a specific software, but I usually use stock charts. And stock charts is all about swing and campaign trading selection. And then I use TradingView for my intraday and swing trading. So these are the references that I could give you. Okay. All right. Any other questions, comments, remarks? September 6th is a holiday. Are you still planning to meet over the internet? Yes, I do work on holidays because I just love it. So I love teaching this material, and I don't want to stop and have those big breaks. Also, what I found is that during the holidays, a lot of people are available and they want to attend live classes where, let's say, on a regular Monday when they work, they might not, and they might have to watch the recording. So I want to accommodate those people as well, and for them just to have the live experience. So holidays, except for like Christmas and New Year, means almost nothing to me. What time would the class be at going forward? So we usually, Stephen, we usually start at 3 p.m. Pacific time. If you are in a different time zone, you can watch on demand. All of the slides, homework slides and videos are usually uploaded by 8 p.m. Pacific on the day of the class. Are you and Bruce going to switch between classes each week? Jennifer, absolutely not. This course is just me. This is the material that I've accumulated for the last 25 years. This is the way how I teach. I would highly, highly recommend three things that Bruce is producing. If you want to look at Bruce, first, go to his power charting episodes, go to his blog, and then go to our class together, WMD class on Wednesdays. So that's kind of like the primary products that Bruce is producing. WTC1, WTC2, that's all me, just based on my trading, my experience in the last 25 years. All right. Okay, one more question and we're going to stop there. And this question comes from John. Is there an indicator or study on any of the software tools that show the Wyckoff phases of similar information? Okay, well, great question. And you could find a lot of VSA softwares. All of the VSA softwares that I've looked at are still not to the quality that I would require for me to make some kind of referral and say, this is the software that I would want you to have. Although I definitely would mention the late David Wise's cumulative wave. So this measures the effort versus result of the swing. So I most definitely would recommend that. And by the way, you can go to our website and find the page that we've dedicated to David, who passed away in 2020. Again, such a unexpected, tragic passing. And David and I spent almost a year conversing and going through a lot of chart. He was mentoring me throughout, that year in 2020, and we become friends really quickly. And it was just a lot of fun to be talking markets. We were like, small kids playing with the charts. And I still feel it inside of me, kind of like this emotionality about his passing. So would definitely recommend the book, Trades About to Happen, any videos that you can find with him, and his software. So his wife Karen still runs that part of the business. Anything else? VSA, any type of software on phases. So we had tryouts where we were able to identify, let's say, phase A and partially phase D, but it's really hard because of the variations on the strength and the weakness of the structures. So it's really hard to find something like this and to create. I've seen some private softwares from my students that have millions of dollars in resources, and they could hire developers, and I've been hired to consult on those type of softwares, but those are private. Those you're not going to find because people don't want to open those up. And usually when people say this is private, that usually tells me that there is something valuable there, and it's possible to create it. But in terms of the public, something available right now, I would not recommend anything. And that's just me having a very, very high, requirements for anything that I would recommend to my students. All right, I think that's it for today. Stanley, I see that you posted this question about when the phase C starts a couple of times. So we'll study this in the first class. So sign up and we'll definitely talk about this. With that, guys, thank you so much. I hope to see you in our classes. If you have any of the questions, shoot me an email at wyckofassociates@gmail.com. I will be happy to see what kind of questions you have, suggest any type of pathway as to how to study, how to build your skills based on this material. And I'm looking forward to our class, all of the students that signed up. Thank you so much, and I'll see you next week. Bye-bye.